Hello guys, welcome to our module information system. In this module, you've been exploring different meanings for what is the so-called information system and how it helps in our life today in the millennium. This is Dr. Mustafa Muhammad. I'm going to take you through one of these important and emerging topics of information system. We could call it actually financial information systems, and it is something to do with all mobile banking and financial technologies that we use these days. These things that we use in our hands, like Samsung Pay, mobile app for HSBC, for NetWest, for all of these banks that we use, cryptocurrency. So I'm going to take you through this journey. We will explore the principles, the basics, why we really need it. Okay, so I'm going to start with you using one of my personal experiences. So I want you to imagine this is me after losing weight, and this is a party. I'm trying to propose a ring for my girlfriend, and the party is ready, everybody's ready, all of our friends are around, and suddenly I need cash because simply the restaurant refused to get a credit card or a Visa card. And in doing so, I had to go out and try to find ATM machine. Well, you might be surprised, even in Europe, even in advanced developed countries, ATM machines are out of service most of the case. So you need to think of another alternative. In that occasion, I was thinking of two alternatives. The first one was, I felt, being really angry. I'm gonna lose my marriage, I'm gonna lose my girl. So should I go to one of my close friends and ask him to lend me some money, and I will be a beggar, and he will have a low status, a high status over me, so I will lose an advantage, I will lose my status. The other way around, I would be a beggar in the street and ask people for a change. So as simple as this, I had to think of having a bank in my pocket. So this is the key rationale behind fintech. We need our banks to be mobile, to be movable with us, and it makes our life easier. Now, this is the so-called Finance 2.0. It's the second generation of financial services that delivers not just efficiency, lower cost, and high speed, but it delivers more innovative delivery of the service, more inclusivity. So how we can really get our end users to be part of the service, and we listen to them and we improve the service. So this is the so-called Finance 2.0. It's an emerging phenomena, came out of the web, advanced web, Web 1 and Web 2, where customers and end users can create materials, can get together to create unintended materials. So I want you to think of how Web 2 could enable people to create new videos, new images, new things, fake things. So out of this, if we go back to finance, financial institutions had to capture this phenomena and enable end users to be part of the service and create the so-called innovation. One of these famous cases, the so-called mobile money and mobile banking, which is a good example of financial information systems. I'm going to take you through different cases, and then we come back together to think of what are the key stakeholders involved, what are their vested interests, why banks are so scarce in developing countries, while in the developed countries, bank branches are almost everywhere. Okay, so if you just YouTube these big titles or press the link, three key cases I'm going to take you through. One is M-Pesa, which is a Kenyan financial information system. It's a mobile money system that enables you to transfer money, as simple as it is. You don't need to have a bank account. So you use your mobile number, and well, you hit it and you become part of the financial service. So I want you to press this link on the slides, watch it, and come back to me. Okay, now I wish you've been watching the video and you enjoyed it. Now, what you can see here, think with me. Are we targeting high-income people? What about affordability? usability of these handsets. These phones need to be very cheap, so easy to own, easy to buy, and then people can use their SIM card to subscribe for the service. As you could see from the video, they had to go to a retail agent, somebody who's trusted from the community. This person been trained and recruited and then get M-Pesa brand logo on his grocery. So a simple trusted person trained in local community. These people help you to upload money. So simply you hand over physical cash and you get it virtual. Okay. Now, who created this? If you read about the history of M-Pesa, you will see Safaricom. What is Safaricom? Well, it's a subsidiary for Vodafone Group. This is something to do with politics as well. When Vodafone Group approach a new market and they try to create a sort of trust bridge, so they had to have another name like Walmart and Asda in England. So same corporation, but actually just different name. So Safaricom is a subsidiary for Vodafone Group, had some alliance with the Central Bank of Kenya. Approvals came through, though it was really difficult. One of these papers that you will see in Blackboard talks about the corrupted relationship between M-Pesa and the Central Bank of Egypt, the director of the director of the Central Bank of Kenya. Sorry. Now, not in every system you will see a space of politics and corruption, but it would be good that we consider these things before we launch any information system, especially financial information system. Okay, now I want you to think with me. In M-Pesa, what was the communication pattern? Was it through SMS messaging or numbers? So what was the case? You will see it's a native mobile app that's been downloaded or installed in the handset, and simply you log in, you do a transaction. A confirmation message, SMS message, would be transferred from your mobile to the recipient mobile and vice versa. Okay, now I want you to stop this video and go to another interesting case, which is Echo in India. Thanks for watching this video. Again, back to Echo in India. I want you to think with me, what are the key differences here? You might notice that Echo is more dial up, so you have to remember or frankly memorize a sequence of digits, including the amount of payment, the code of the recipients. So it feels like you need to rely much more on the retail agents, which is not the case of M-Pesa. Now, India and the slums in India, this is a big market, which is full of informal economy. So people are not really taxed out there. So a bigger market, it was more challenging to grow up and scale wide out there in ecosystem. Now, in ecosystem, this system was developed mainly by the Central Bank of India. So it is a bank, a governmental institution, who recruited IT skillful people to launch the system, to deliver it. So the key player is a bank. While if you go back to M-Pesa, the key player is Mobile Telecoms, which is Vodafone Group subsidiary called Safaricom. So in the first case, which is M-Pesa, the key player is non-bank actor, while in Echo, the key player is a bank actor. So this is one of the differences. Dial-up versus text messaging and native mobile app. Is population number is really massive in India. So it was really competitive to launch one platform everywhere in India. Now I want you to stop this video and watch this smart money case, press the link and come back to me and tell me what is the difference between these three cases. Okay, thanks for watching the third video. This is another interesting approach, which is more developed approach. So developing countries usually start with massive resources. They go and deliver something with customer service center, It usually deals with smartphones and highly educated customers. They deal with high-income people and middle-income people. Now, what you might notice in this video, you have to subscribe online and then download the application in your mobile phone. So it's a mix of both. It's a hybrid platform. It's not native like M-Pesa. It's not less advanced as Echo. Okay, now there are other cases that you can visit, cases of Pakistan, cases of Echo again, but more advanced scenarios and stories. The most interesting one that you would see, which challenges the banker's argument. So bankers usually say it's not profitable. It's really difficult to have a successful banking and financial service out there. So these are Child's Play. It's another Indian system that's been developed by Indian kids. So kids between 11 to 14 years old, they delivered their own bank in India. And this is the Russian news telling you about the case. So watch this video and come back to me. Good. I wish you enjoyed this video as well, and you could see the ambition of these young kids who delivered their own bank and how they manage it, and their dreams of futures to be policemen and engineers and doctors. Now, in summary, if we try to compare between different cases, the location makes a huge sense. The access for this service, the population, the targeted population, technology used, is it mobile enabled, is it web enabled, is it hybrid, is it SMS messaging, is it dial up, the model used, who are the key leaders, bank or non-bank, who are the key stakeholders, who are the key providers, the services offered, are we talking about just mobile payment, mobile money transfer, insurance, micro lending and microfinance? So what sort of service? And the final outreach, the final number of users during the history of progressing within this system. Okay, this is one of my research framework that talk about the history overall and classifies the so-called fintech. So you will see upside Egyptian pyramid. On the right side, you will see developing countries, and on the left side, you will see developed countries. Now, this is quite interesting because the way they twist and marry technology with financial services are different. The right side, where we have needs, social needs and financial needs. People in developing countries are not really banked and they need financial inclusion. They are desperate to get money so they can raise income and afford the tuitions and living expenses for their kids and their families. So frankly, in this approach in developing countries, we had to create models and business technologies that pull people into the financial service, into the banking service. While in developed countries, think of yourself, in America and England, can you really live without a bank account? It's quite challenging. So you have to have a bank account. And accordingly, banks and financial institutions create new technologies and keep targeting same customers. And a clear example of this, if you see the progression along this pyramid, if you go down, 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 the developed side, you have computerized banking information system, you have intranets, you have telephone banking, e-commerce, all of them still target same customers, which is frankly 20% of the world population. On the other side, you will see more creative fulfillment to needs of customers. So you will see loan tracking services. In these countries, it is really difficult to give a rate for credit. So poor people might, be immoral and apply for microcredit and then move to another city, move somewhere else. So we had to develop something called loan tracking system, mobile tracking system. Well, same thing apply for rich people. but the need wasn't really there. The full dream for both sides is to move towards cashless society, so everything would go virtual. Can 5G enables us to be more reactive in these systems? This is a question to be answered. Okay, so in every model, bank-led and non-bank-led, you have different stakeholders, and the key trick here, in the bank-led, the bank takes the risk of managing the financial portfolio. So they are the key people here. It is their own baby. But then they might recruit IT people to design the system. While in the non-bank-led, we are talking about mobile telecommunication company or IT developer who would take the risk when they diversify into a new market, which is financial service. So they are moving from telecommunication into finance. Now, do you think we can trust a company like Vodafone or O2 or these telecoms with our money? This is something to be addressed as well. Where in non-bank-led model, banks are just there to offer a current account. So these companies who lead the system can put every liquid money in a bank. So the bank is not in charge of managing the financial portfolio. Okay, so I want you now to think individually. Who are the key stakeholders of mobile banking and mobile branchless banking or fintech in general? What are their benefits out of this? If you wanted to do some sort of stakeholder analysis, so I want you to think with me, macro level, which is regulatory level, meso level, which is operational and providers level, and micro level, which is mainly user level. So if you try to answer these questions that I told you, maybe you think of developing a table. So you list these stakeholders and you might add extra stakeholders. It depends on your country. Where are you located? Are you located in Africa? There will be different actors, different partners. And then I want you to suggest what sort of benefits for each party. Think, for example, mobile network operators, mobile telecoms. Why they would be interested in this? And you might discover, okay, if you do have more than SIM card at home, I do have more than three to four SIM cards in my pocket. This means telecommunication service is really saturated. So the market is really full. The penetration rate is more than 150% at the moment, which means all telecoms, they keep competing within the same cake, taking different market segments, stealing from each other, fighting with each other. While if they migrate towards a new financial market, this means they are taking part of another cake from the from bankers and financial institutions. Okay, now there is a burning critical question here. I want you to think with me why banks are so scarce. There is a supplementary paper in Blackboard, you will see it on the bottom of today's lecture, by Ian Mass, and it talks about why banks are so scarce in developing countries. So I want you to think first and then read the paper and come back to this video. Good. Thank you for doing the efforts, reading the paper. I hope you enjoyed it. And maybe you try to compare and contrast between your own solution and the paper. Okay, now there are three key reasons why banks are so scarce in our countries or in developing countries. So if you go back to Nigeria, for example, only capital city you will have many bank branches, but if you go to the south, if you go far areas, you might find rarely one bank branch. And the reason for this is that bankers still believe low profitability. So they assume that whoever has low income, they won't deposit enough money, and this money wouldn't be circulated by the bank. So zero return on investment for the bank. At the same time, low income people will do more daily transactions, which means they would require more manpower, accountants, staff, to do these transactions for them. Now, this is not easy It means salaries to these employees, time taken out of strategic banking operations. The question is, now, if bankers assume low profitability for affordable banking and retail banking, now how come companies like Unilever could produce small sachets of shampoos with affordable prices and invade the Indian market with it? How come you can go to night grocery shop, and you buy a can of Coca-Cola or Pepsi with a few cents or a few pences? Which means these fast-moving consumer goods could really highlight the so-called base of the pyramid people. So they could think this way, and this argument is Prahalad's argument. He's an Indian professor. He thinks that in our world we have top income people, middle income people, and bottom or base income people. And this base is actually much bigger than people on the top in terms of number. So if we assume that 80% of the world population earn less than $3 a day, which means they are as a base. Now, if you get a small base of their income for something you produce with this big number, you might achieve, if not equal, maybe much more profit than you can achieve from the people on the top or the rich people. So this is the argument. Low profitability is not a strong argument by bankers, but this is the reason. The second one is infrastructure gap. So I want you to think of people who live in Africa or live in Latin America. Many people live on wages. So they get physical cash, and the challenge is how to turn it into a digital cash. So digital infrastructure, internet, cloud computing and mobile cloud applications, telecommunication regulations and other things. On the other side, in developed world, people get their salaries in digital. So my challenge, for example, is how to find ATM machines so I can pay in cash. For the parking, you might need to pay in cash. For some applications and some sort of business, you need to pay in cash. So now, how we can bridge between both of these worlds, this is a big challenge. And this is why bankers keep refusing launching mobile banking and mobile finance. Now, the third one is regulatory barriers. As we all know that in a normal bank, 15% of your deposits will go to the central bank. And this is a mechanism to borrow money from different banks and offer a sort of insurance cover. So in case of bankruptcy, any losing bank will get an immediate coverage from the central bank, which means every bank branch will have to have full transparency of all documents, financial statements and balance sheets and blah, 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 all these documents. Security, privacy, all these things need to be maintained in a normal bank branch. The question is, when you have a retail agent for M-Pesa, do you think this is a guaranteed and secure source of banking? Can anybody go just to steal the money out there from the retail agent? This is a big challenge that bankers use to say, okay, we cannot do it, we cannot deliver such a system. Okay, now once you start thinking about mobile banking or any fintech model, you need to think of these key elements. You start with service agility and you think of a business model. So how the commission and transaction cost would work, what sort of information that need to be processed, how you manage the files and data, and then you want to think of the computing layers. Now, I'm not expecting you to be technicians, but you need to be aware of these layers when you talk about a system in your report. When an institution asks you to deliver a system for them, you might be a system analyst. If you do have the computing skills, then you know what I'm talking about. So if we think for a full circle, from the right side, you have the main company, which is, for example, Vodafone Group. They do have accounts and service platform. It's back-end operation where the customer service is located. On the left side, you have the end user with his or her mobile phone. They need to come to the retail agent who is trained. This retail agent need to have a scanner a PC or laptop connected to the internet, so they can print documents for you. They need to have something in their wallet, in their belt, which is a reader and a printer, so they can print the transaction for you and tell you, okay, this is a physical confirmation, especially when you deal with low-income people. Okay, and then in between you have electronic payment network, and this network manage all the retail agents and put everything back into the back-end operation in a processed way, in up-to-date real-time processing manner. You need to think of the functionalities of these mobile phones handed to your clients. So how it would look like at the end of the day, how much would it cost? Does it need to include near field communication feature and wireless things? How we can secure it? All these elements need to be considered. Okay, now I'm going to take you to the last element of this lecture. Nothing is free of risks. So if we develop any sort of information system, there is a high chance for risk and failure. Unless we understand this, we wouldn't be able to avoid it. So credit risk, for example. Now, if you deal with retail agent or Vodafone or operators, all these levels might bankrupt. So the retail agent, you might approach them and ask them, okay, can you give me money? They don't have cash, so maybe they go in debt because they keep giving you their cash and then they don't have cash to manage their own business. So you have credit risk, you have liquidity risk. They are not trained to be accountants. They need to close the shop and go back to the bank to hand over the cash they received in case of too many cash uploads. In peak hours, they might do a transaction for you as a client, but then it takes an hour or so. So you might feel, okay, my money was stolen. And this creates, so this is an operational risk, but at the same time, it creates a reputational risk. So it affects the retail agent reputation, the company's overall reputation. Last not least, money laundering. So these systems started in really developing countries like Kenya, which is next to Somalia, and there was a national war out there, so there was a high risk of money laundering. Same thing applies everywhere. So this is one of the key risks associated with the system. Thank you for stopping by, and I wish you enjoyed this session.